good morning. It's Mary Ellen McGonigal, and this is the MEM Edge Show. And this is the show where we put you in front of where the action is in the markets. And there's certainly quite a bit of activity going on as we enter this second week in November as far as the markets are concerned. And a lot that we can cover here today because, as you can see, the broader markets are coming under a bit of selling pressure. So let's go ahead and take a look at what we are going to be reviewing here today. The first item, as always, we are going to take a look at the broader markets, take a look at where the current markets are. And there's no more important time than now to really have a handle on where the broader markets are. And not only that, have a plan going forward as far as a process, what you would need to see in order to turn more positive on the broader market. So we're going to go ahead and review that, help you put together a plan here, given the current volatility in the market. It's remaining at high levels. So we'll uncover that. Also, we're going to take a look at some pockets of strength within those defensive groups, and that's going to take us to the consumer staples, some of the REITs and so forth. Last week, defensive groups came under pressure as the broader markets had a significant rally, and but with that broader market focus in mind, you are going to want to have a sense of where there is strength in these defensive groups. And then also seeking possible candidates. Now, here I did say ahead of earnings, but we are still very much in the thick of earnings season. And while oftentimes the broader markets action will overtake regardless of whether a company comes in ahead of estimates. But last week, we did see quite a bit in the way of stocks experiencing a lot in the way of rallies and pops based on strong earnings that had everything to do with those stocks that were really deeply oversold. So any kind of good news was really celebrated. So we're going to take a look at some companies that are going to be reporting this week. And I will tell you, I'm not a fan of getting in front of stocks prior to their earnings. So really, we're going to seek possible candidates ahead of their reporting of their earnings. So it's with an eye toward what to look for so that you can potentially capitalize on some of these big spikes that are happening out there on positive earnings and sales reports. And then also we're going to review uncovering next cycle's outperformers. And while we may be a little bit early in the markets as far as the process of a recovery or a potential recovery, here's another area where you will want to have a plan in place so that you can have a watch list so that when the markets do in fact turn positive, you can have this list that you can potentially pull from to take advantage of any kind of downtrend reversal or bullish uptrend that occurs within the broader markets. So let's go ahead and get started. The first item that we're looking at here, this is a daily view of the S&P 500 large cap index, and we are looking at the index into the close last Friday. It's not going to be terribly changed from there, but let me go ahead and review again what I've done in the way of overlaying technical indicators and also simple moving averages. And these simple moving averages are really going to help guide the way, because when we look at the broader markets, it is a break below these simple moving averages that's going to really alert us to potential trouble ahead. Likewise, we are going to want to see need to see a break back above. So let's go ahead and review. This green line here is a 21-day simple moving average. Quite simply, this is a smoothed out line that is providing you with the price action over the last 21 days. And of course, the slope of this line, as well as the position, is going to be equally important in a bullish phase in the markets here. We're looking again at the S&P. You can see that the shorter term simple moving averages are very much in an uptrend, and the index is finding support at that upward trending simple moving average. So we can see, taking us back to the beginning of last month in October, we started to get a break break down below that, take a look at the volume. That's going to be very significant because this volume is telling you that institutions are exiting the markets. And of course, these guys run billions of dollars, so you're going to want to pay attention to any kind of break on volume. Now, this red line is a 50-day simple moving average. Same principle applies as far as this 50-day is going to be your intermediate term indicator. So we want to see this 50-day simple moving average in an uptrend. Quite clearly, we are not at this point in time. The 50-day is trending downward. And then equally concerning, of course, is this big break below that 50-day or intermediate term indicator. Again, we're keying in here on this volume. And your 200-day simple moving average, this is your blue line here. We are holding steady as far as flat. But again, ideally, you do want to see that in an uptrend. Breaks below this 200-day simple moving average really are obviously not positive. This is really quite negative. When we get these breaks, we can go back to the correction in earlier this year, 2018, back into this February, March, even into April period. We did get brief undercuttings. Certainly in April, the S&P 500 broke below that 200-day simple moving average, but certainly not to the extent that we are seeing here. So this really presents a picture as far as, without even having to go into the markets, look at individual stocks, you can get a sense that there's been quite a bit in the way of damage where these stocks, and in this case, the S&P 500 has broken down. So we are going to need quite a bit in the way of time to repair these breaks. So what we're looking at here is last week's rally. The S&P 500 was up about 2.5% last week. And we can see that it rallied right up to this downward trending 21-day simple moving average. So what we are going to be needing to see and on the lookout for relative to these moving averages is a break back above. And ideally, our first break will be, of course, this 21-day. But if we see a break above the 200-day simple moving average, and even more importantly, we're going to need to see a close above that. That could be your first sign that the markets are at the very least stabilizing. So this 200-day is going to be your first area of upside resistance. So we're going to need to see a break above that. Then beyond that, we will need to see a break above this 50-day simple moving average before we can really get truly constructive. You might see action between the break above the 200 and the 50. You might see some positive action in the markets during that period, but ideally we do want that break back above the 50, and we can go back historically. This is where history really is going to serve you well. You want to study the markets. We have this correction that occurred not that long ago, so you can look at this daily chart, take a look at what we are going to need to see, because it wasn't until this latter period that we really did get an extended upward move here in the S&P. But again, we want the break here. We can even go back into this April-May period, these breaks back above these shorter term simple moving averages, because eventually, ideally, what will occur once that break happens above is these simple moving averages are going to be drawn back into an uptrend. That's what we're going to want to see. So let's take a look at some of the other indicators we have. I put the RSI, that's a relative strength indicator, up on the top here. We can see that this bullish phase here, April, May into June, the RSI for the most part was up above this dash net neutral in positive territory. So that is what you want to see. I'm pointing out this July where we had this slight pullback in the latter June period, and then the downtrend reversal in July, that RSI back above the net neutral. Let's take a look at where we are now. The RSI, last week's rally certainly helped. It did put the RSI into an uptrend, but we are still below this dashed net neutral. So we would need to see that in conjunction with any break above the simple moving averages. And then on the bottom here, I have what's called the stochastics. This is another momentum indicator. This dashed line here is also similar to the RSI. This is your net neutral. So last week we did get a break back above, and that really certainly was encouraging, no doubt about it. But again, we want to see these signals occurring in conjunction as far as any type of potential downtrend reversal in the broader markets. Let's go ahead and take a look at another really relevant index at this point in time. This is the Russell 2000 small cap index. We're looking at a daily price chart. Take a look. The small cap stocks really just fell off a cliff, so to speak, and we can see this significant drop. They started to show signs of weakness back in September, and the importance here of paying attention to the Russell 2000 is oftentimes small cap stocks will lead the broader markets. So let's go ahead and take a look back here during this the correction earlier in February into March. We can see that relative to the earlier S&P, that the small cap stocks really came on strong quite a bit earlier. They did lead us out, and this is very typical of how small cap stocks behave. You can go back to 08, 09, take a look at the Russell 2000, and you'll see that that index did, in fact, was the first to exhibit signs of positiveness. So let's again key in on where we are now. We can see that this significant drop here in the Russell 2000 caused the RSI to get really oversold. As it gets below this 30, these grayed out areas here are indicating that the index is oversold. That's with an eye toward at some point seeing a bounce, an oversold bounce. And we did get that last week. The Russell 2000 of the broader indexes was up 4.4%. So it had the most significant rally last week. And what I wanted to point out to you here is we're using different, I have a 10-day simple moving average, and that is relatively more relevant, if you will. We can see that the index broke back above that 10-day simple moving average. So now we have a little more room to run, so to speak, because your next area of possible resistance is going to be this blue 200-day simple moving average, and that is taking us up to a level that's quite a bit higher. So we do have a little more room here to run, so to speak. We can see down below I have this MACD, a moving average convergence divergence. We have this positive black line up through the red, but we are still below zero. So while interesting, again, we could see small cap stocks continue to have a little bit more of an upward movement. We're going to key in on how you can identify candidates for those of you that are shorter term in your trading. At this point in time, putting new money to work with an eye toward longer term gains is not advisable, but many of you may be more active in your trading activity. So with an eye toward that, we'll go ahead and review ways that you can potentially get in front of some of these smaller stocks that may in fact have a little more upside in front of them over the near term. So let's go ahead and we're going to take a look using, of course, stockcharts.com, Candle Glance. This is a wonderful snapshot view that you can access from your initial page interface. You can just go directly to Candle Glance, and from there you can populate this view. These are 12 thumbnail snapshots of, in my case here, we're looking at various indices and ETFs for sectors. And the beauty here is being able to very quickly assess where strength or weakness is in the broader markets. And what I've done is not only these snapshots here are using a 20 and a 50-day simple moving average. I've also overlaid an RSI, that relative strength indicator, and then descending order. And let's go ahead and just take a quick look at some of the different indices and where we can see potential pockets of strength. Gold shares are still trading up. There's a lot going on in the way of M&A activity within gold stocks, but also higher yields, safer haven. So we are seeing gold stocks holding up really quite well. Volatility index dropped a bit last week when we saw that nice significant rally, but it is still quite high. Anything in that 18 to and above range is going to point toward higher volatility. So we are at 20 today on the VIX, that's the volatility index. But from there we can see that financial stocks, now this is an area that got very deeply oversold, was really suffering for quite some time, but we did see a rally last week significant. It was one of the strongest, 4.4% gain last week, one of the strongest sectors. And it had everything to do with really just how oversold these stocks got. And the valuation levels got attractive, and they are rallying again this week. So far, they're up a little over 1%. And we can dig in and take a look at some of those financials. But from there, we can see that the industrial stocks are holding up better than some of these others. Consumer discretionary, that's another area that was up 4.4% last week. There's a lot of significant activity going on in, certainly not Amazon, that's down again today, but some of these smaller retailers that really held up well in the beginning of the year are coming on now strongly. And then from there, healthcare. And this is an area we've talked about where there are pockets of growth, but also areas that are defensive. Some of these bigger cap pharmas would be a way to get a little more defensive as far as expanding your portfolio if you're willing to sit through this current correction. So what we can do is drill down and take a look. Now, oil, this is USO, the US Oil Fund. It trades based on the price of oil, and we can see that the price of oil has had a significant decline. It's bouncing a bit today on news about U.S. sanctions against Iran being removed. So we're getting a nice bounce there. And you can imagine there are some equally deeply oversold energy stocks that are bouncing with this uptick in the price of oil. But again, this is all going to be, I would say, shorter term for those of you that want to play that type of a bounce. So let's go ahead. I talked about some areas that we can key in on. And the first area that I did want to take a look at are some of these defensive stocks that can be, again, a counterbalance within your portfolio. So what I'm going to go ahead and do is access the S&P sector summary. This is for today, and it's ranked by percent change. So again, we can see these energy stocks picking up today via the price of oil, financial stocks. I talked about this. I'm with my MEM investment research. I put out a bi-weekly newsletter, and I talked about financial stocks and the fact that there is still a bounce ahead. And indeed, they are seeing another uptick here because of just how beaten down these stocks got and the relative valuations. But let's go ahead and take a look at consumer staples. This is an area, of course, where these higher yielding stocks are going to be attractive, particularly in a high volatility period when the broader markets are trending downward. So what we can see are some individual areas that are picking up well. Now, what you can do from here is go ahead and hover over the ticker symbol for that subgrouping and take a look. This is Brewers. You can see again how deeply oversold these stocks got. These are the names that are tending to bounce a bit more. Personal products, again, very, very oversold, and so forth down the line. But what I want to do from here is go ahead and take a look at some of the areas that are within consumer staples that are holding up well. And there are very sound reasons for the fact that they are. And these are the types of stocks that I would like to, I traffic in. I like to see higher quality rather than playing those poor quality bounces that may be occurring. So what we're looking at here is the consumer staple food products. I've then gone ahead and sorted it by this scooter rating. For those of you not familiar, this is a longer term technical rating. The higher the number, the better. So these are your stocks that are withstanding the downward pressure in the broader markets. They're holding up quite well. So really, we can just drill right down. This is a stock I've talked about over the last 4 weeks, MKC. It's McCormick and Company. So we're going to go ahead and take a look at the daily price chart here. And really, there's looking at this, you would not get a sense that there is any kind of correction going on in the broader markets. The uptrend is firmly in place. We talked about an upward trending, shorter, simple moving average. This is your 10-day. The company or the stock is finding support at this upward trending 10-day simple moving average. This stock offers a 1.4% yield, but equally important is the fact that the earnings outlook is really quite positive. They're looking at a 17% overall year-over-year earnings growth for the company this year, 8% next, and analysts are continuing to revise their estimates higher. So this certainly would be one candidate. Let's go ahead back to that sector scooter sort of these food products. And what we can do is take a look at another potential candidate within this space. This is another one that we've talked about in the past. HRL is the ticker symbol. This is Hormel Foods. And we can see another stock that really is just ignoring all the downward pressure going on around it. It's in a very strong upturn. You can see that the MACD had this positive signal crossover. The RSI is in positive standing. Again, stock finding support at an upward trending 10-day, very constructive. And this is a company that already came out and reported earnings, and the street really celebrated it. They have bought a couple of new brands, and they were introducing new food products that are being met with quite a bit in the way of demand, so that is, of course, driving sales and revenue. And let's go ahead. I wanted to take a look at another area within consumer staples. And really, again, for those of you, go ahead and sort it by scooter. You can go ahead down. LifeVantage is a vitamin company that is doing really quite well. Medifast is a dieting. So you can go ahead and overlay your cursor on that ticker symbol and take a look at the stock. Lancaster is another positive one. But let's go back to consumer staples and key in on another area that is showing relative outperformance, again, while these broader markets really are suffering. And one area I would point you toward are these food retailer and wholesalers. And again, this scooter is really going to help you because it will point you to where the strength is. As cited before, oftentimes the strength that you are seeing, there's a really relevant reason for it. So we can take a look here at CASY. This is Casey, smaller retail food. The company has a 0.9% yield, so you're not really buying the stock because of the yield. Let's see if we can pull this stock up, because as you will see, the stock is very much in an uptrend. While we're waiting for the chart, take a look at the daily chart of that CASY. And that was the company that I was mentioning, where the earnings profile is really quite strong for this company as far as estimates for this year as well as next year. The stock does have a little bit of a yield, but take a look. It pulled back quite nicely to that upward trending 50-day simple moving average. We talked about this being your intermediate trend. And we can see that the stock is, the RSI is trending positively. This particular company is, it's a really, it's all about the turnaround story. The company actually came in with 7 quarters that were negative, year-over-year negative earnings growth, but things are really turning around and brightening up. They reported earnings here. We can see this gap up here, the beginning of September, very positive, very strong. So this is another stock that I would point you toward. We are getting a little light on time, so I'm going to point out a couple of other stocks. This is Procter & Gamble, nice 3.2% yield. This is their gap up on earnings. You can see the RSI trended quite positively subsequent to that. And the MACD had a positive crossover and is up above this net neutral or zero line. So Procter & Gamble, the stock is up today in a down market. This would be another potentially ideal candidate. And then one other stock within consumer staples is Estee Lauder, EL. And this company did report earnings last week that were ahead of estimates. We can see this gap up. Now, this stock is not as compelling because there's a little bit in the way of what we call overhead supply. That means as the price advances up to this prior high, you may see selling, but it's one to certainly keep in mind. It's not the most attractive by any means, but I did want to go ahead and point out that they came out with really nice earnings. The company has a 1.2% yield, but their earnings were 23% above estimates. So that would be one to keep in mind. Now let's go ahead. I talked about small cap stocks and the potential for a continued move in that area. So what I wanted to do is go ahead and show you how we can embrace or get in front of potential candidates. So I'm going to go ahead to the initial page here with stockcharts.com, and we can see that down here we have what are called scooter reports. So we talked about that being a really incredible technical indicator. So we're looking at scooter reports. The initial interface is large cap stocks. So what we want to do is go ahead and access small cap stocks, and it's automatically going to go ahead and sort it by the scooter rating. And again, this scooter rating is going to guide you toward those stocks that are holding up really quite well. And as mentioned before, oftentimes there is a reason that they're holding up well. So let's look at this Tandem Diabetics TNDM as a potential small cap candidate that may have a bit more in the way of upside ahead of it. The reason I'm pointing this stock out is because take a look at the significant gains the stock had. It's really well loved by the Wall Street. They have a Tandem diabetes care. They have products that are in very, very high demand. So we can see that the stock has pulled back in line with the broader markets, but it's been in a much more orderly fashion, not a super break. So when I'm looking for candidates, I want to see these big winners. They are big winners because of solid earnings growth, high demand for products. So when they pull back, oftentimes you will see and more upside ahead of them because investors are looking at the stock as having being quite a bit cheaper than the prior period. Now let's go ahead back to this scooter. And again, we can go ahead and quite simply just overlay your cursor on top. Turtle Beach is another stock that was a big winner in the beginning period but we can see this nice pullback here to its 200-day simple moving average. It is breaking back above not only that shorter term 10-day, but also that 50-day simple moving average. So it's all with an eye toward potentially being able to bounce. One last thing to point out before we end things here is taking a look at some of these stocks that had big moves last week. TREE, I talked about setting up candidates ahead of earnings. So what we are looking for here is a stock that's very, very deeply oversold, came in with good numbers, had a significant move. So I'm going to go ahead and leave it at that by pulling up the 1-hour chart and giving you a sense of how you can trade these gaps up. So take a look at that. It had a gap up and continued on from there. But again, leaving it at that. Take care.
If you're interested in trading Alexander Elder's Come Into My Trading Room or Trading for a Living book, we have the settings on stock charts to do that. First of all, the Elder candle style. Then you could use Keltner bands to set up the width. These are adjusted based on the ATR. And the force index, of course, as well as his MACD, or the regular MACD. So here's how you do that. You'd select Elder Impulse System from the drop-down menu on Chart Type. You'd select Keltner channels and pick the width that you want, and it has to be one that fits nicely. And then Force Index and MACD. And again, the way you pick the Keltner channel width is you want it to just touch the top of most of the primary uptrend bars so you get out just at the right time. Anyway, enjoy trading for a living.